Good morning, good afternoon. Right, how's life? Damn, it's getting really cold here in Bay Area. Uh, hey, SP, how are you? Wet and cold, true. It's been raining since morning. Not that I had to go out. I was preparing for the session, but my wife, she went out and she was like, "Oh, it's raining." Yeah, it is. It's okay. We need the rains. We need the rains. Yeah. Sam says I eat tons of garlic now. Garlic is good for, again, not it's not a medical advice, but garlic is good for controlling cholesterol. It is, I mean, again, this is one of the home remedies which you see common in eastern part of the world. So it's got a lot of medicinal benefits. Garlic, good for heart. It's 16th in Iowa. Oh, geez. Anyway, so after $28 medical bill, geez, that's brutal. So I hope, Sam, you're feeling better now, and yeah, take care of health. There is nothing more important than health. I think that's the first thing in a life, and then comes all other stuff, money and everything else can wait. That's what I'm saying. There is no investment worth losing sleep or losing your health. One-on-one, basic one-on-one of investing is has nothing to do with money. It's all to do with your health. Okay. All right. So today, I have two topics to, from a big topic perspective. One is maybe look at some portfolio protection strategies or portfolio, how to, again, not going to go too much in detail, but at least I see a lot of chatter around, these uncertain markets and how to use options to protect portfolio. This itself is a big topic, is a topic itself deserves, let's say, 2 to 3 hours. I had covered this in one of those option boot camps, which I used to do earlier. It took us, 2 sessions to just talk about portfolio protection, which means almost 4 hours. So I'm not going to get into those details, but maybe we'll look at some of the strategies. And then the other thing is interesting read I got through, last week was around quantum computing. So that got me interested. And so looked at, some of the opportunities around quantum computing, the state of market around quantum computing. So yeah, I do want to share that as well. And of course, we'll look at what happened in the markets last week, anything newsworthy, anything, which on which we can build our investment thesis, etc. So that's all I have for today. What else do you guys want to talk about? Anything you have in your mind? I mean, this week was, I would say it was a great week. So, but how it's going to be next week, next month? We don't know. Okay. All right. So maybe let's get going. Anyone made any changes in the portfolio based on what we saw in the markets today? Anyone tried anything new? Or does that give does this week give you some comfort that we may have seen the bottom? Again, I don't know. I'm just asking. Still doing spreads and cash secured puts. Okay. Yeah, that's a good way to stay engaged. Yeah, I've been doing, this week was probably, and I think especially Friday was one of my most active days because December expiration is coming closer. So I've been rolling off most of my positions from, closing out December positions and building January portfolio. Uh, all right, so guys, let's dive into today's session, and we'll be happy to answer any questions that you may have, and let's make it a little more interactive. Okay, all right, let's get through it. Like I said, two big topics. One is around portfolio protection, and another one is around quantum opportunities. We'll see how much we can cover today. So let's jump into it right now. As always, everything that we talk here is only entertainment. Nothing is financial advice. So please don't go and trade based on what you hear. Okay. Use your own opinion, use your own judgment. So yeah, before I jump into today's session, I thought maybe we'll go through some of the quotes. I'm a big fan of quotes, especially from the people I admire. So for today, there are 5 quotes from Charlie Munger. He is, he doesn't need any introduction, but he is very generous with his words. So I love reading what Charlie has to say. The first one I want to go through is: investing is where you find few great companies and then sit on your ass, right? It's more around, again, it's this perspective. It's more around the time in the market, how long you have been in the market. And this is one of the most difficult thing to do, especially in 2022. It's sitting and doing nothing is one of the most difficult decisions that as an investors have to make. Right? One of the cognitive biases we reviewed last week was an action bias. We always feel that I have to do something to make money, but I think some of the great investors, they always find a great companies and then sit on it. The companies will do what they have to do, right? Do I subscribe to this 100%? Probably not. I still take action after buying great companies so that I can sit on my ass holding those great companies and not get scared out. Right? Let's look at next one. This is what I 100% subscribe to, is like Warren. I had a considerable passion to get rich, not because I wanted Ferraris. I wanted the independence. I desperately wanted it. This was why I got into it. Investing is, I do want to create my own source of income in which I am not dependent on anyone else. I want my independence. There is no, I think, in my opinion, there is no defined age of when you may want to seek this independence. Traditionally, people would say, okay, hey, let's work till 60s, whatever, 60, 62, 58, whatever the retirement age is during that time. And then you become independent. I think over the last decade, world has changed, societal norms have changed. I see a lot more people retiring early, or changing your lifestyle to gain your own independence. So one of the reason, and I think the most important reason why I got into investing is, and became a serious in investing, is I want my independence. I'm not looking for Lambos. I want to be rich in terms of how many hours of the day I have under my control, right? So I'm looking for that sort of wealth, is I control my own time. I'm there yet? No. But I think over the past few years, is it getting better? Yes. Do I have the same level of dependency what I used to have in mortgaging my hours to earn? No. But yeah, few more years to go. I would say few more years to go. Third one, assume life will be really tough and then ask if you can handle it. If the answer is yes, you won. This is more of a life lesson, I would say, than an investment lesson. Assume that life's not going to be easy. It's a there's a saying, right? Prepare for the worst and hope for the best. Fourth, this is what we saw in 2020 and 2021, right? Think of the basic intellectual dishonesty that comes when you start talking about adjusted EBITDA. You're almost announcing you are a flake. The other more colorful quote around the adjusted EBITDA is, I think that's also from Charlie, is adjusted EBITDA is BS. Right. Again, we saw this became more and more prevalent in 2020 and 2021, especially among a lot of SPAC companies and a lot of new IPOs, because there are no earnings to talk, no earnings to show. So we moved to EBITDA, and then there was on top of EBITDA, there was all adjusted EBITDAs. Right? You don't know what adjustments have been made, so it was very important to go and look under the hood on what are those adjustments. But how many investors actually do that? Right? Not many. So make sure if you're seeing a CFO, CEO don't talk about it, generates a CFO coming in talking about adjusted EBITDA in the earnings call, our antennas should be up and trying to look for, okay, guys, what's those adjustments, right? And last one is, if investing wasn't hard, everyone would be rich. Very true. But unfortunately, over the past few years, investing has been made to look very easy, made to look, get rich quick, but it's anything but get rich quick. In a short term, maybe a month or a year, everyone thought we are the next Warren Buffett. Then you look in the mirror and then you the person I see in the mirror is the next Warren Buffett. I think 2022 has brought everyone back to reality that it's not easy. It's not casino, right? We need to do the work, and that is why I put in the work every week to become better investor, to learn. There is always something to learn on every week basis, and that's what I learn about markets. It's never stale. Even if you have not bought any shares, even if you have the same positions, there's still every week there is something to learn and grow if you're invested in markets. And nowadays I find that 24 hours is less, right? Given all the other stuff, there is always so many things to learn in the markets. It's not easy, but the mechanics of participating in the market has become easy. But I think the timeless principles of finding investments, or where we should invest, how we should invest, that is still the tough job. Right? Whether it is going through the companies, whether it is going through maybe subscribing to some investment reports, we still have to do the hard work. And few brave souls who come here every Saturday for 2 hours are doing the hard work, and I'm also doing hard work from my side to make sure I learn and I can share those with you. There's a copy paste these quotes in the chat so you can use it. Sure. There we go. Why someone requested for this? There we go. All right. With that, let's jump onto the macro side. Not that I'm a macro investor, but it helps to know what's happening at overall in the economy. I am still macro investors won't differentiate between what's Coke versus Pepsi, right? They won't get into the details of how Pinterest is different from Snap, right? All are social media companies. But I am not macro, but it does help us to know overall, because all the companies are impacted by the changes in the macro economy. 2022 has told all of us. So I do want to look at what's happening on the macro side. So there was a news around interest rate hikes. Fed chairman, I think it was on Wednesday, he made a remark. It was at a Brookings institution. And he made a remark that, maybe going forward, Fed will try to slow down the pace of rate hikes. Now, after that, the market was going gaga over this comment. And we saw a huge, run up in the markets on Wednesday after this comment. I think NASDAQ was up, almost 4%. Maybe a percent off one or here or there, but it was a huge, run up in the markets. It shows market is so desperate to hear anything positive in terms of interest rates that, people are talking about Fed as pivot. There's no pivot yet, right? And I'm now getting sick and tired of those CNBCs. Only thing that they talk about and bring in, any of the contributors, it's so focused on what Fed has to say, right? Don't get me wrong. I mean, Fed has, at least it is one of the most important players in the market, but at some point of time, like, come on, guys, is there any other topic that we want to talk about? Can we talk about some companies, some businesses? I only have a limited time when I can watch something. Mostly it's, before my office work and maybe during the lunch time. And all I see is what Fed has to do. And everyone have their own opinion on, has Fed pivoted, not pivoted? What's the definition of pivot? That's also unclear. Is it they're going to slow down the rate hikes, which is what Fed has told, which is they want to slow down the rate hike. Doesn't mean that they are not going to hike the rates. Rate hike is it's still going to be, in December, they're still going to hike the rates. May not be by 75 basis points, maybe by 50 basis points. That's what probably Fed is hinting. But pivot is a different one. Pivot is, I'm not going to hike the rate. Maybe I'm going to reduce the rates, right? So we'll see. But market is hungry, is desperate for any good news. So we saw market going higher on Wednesday. It was Thursday or Friday when the Jolt report came out, the jobs report. And then we saw US added more jobs than forecast in for the November, and wages also surged by the most in nearly a year. So then market pivoted to the other side, saying, oh gosh, good news for jobs is bad news. Good news for economy is bad news for market. Yeah, it sounds weird, but this is the reality. Market is looking for help from Fed, and if the economy continues to stay strong, if the job market continue to stay strong, and the wages surged, that means inflation is not going to come down anytime soon. So after this strong job market report, stocks fell, and eventually I think the stock market closed almost, equal, maybe 1% up for the week after the fall on, I think, Thursday, and little bit recovery on Friday. But anyway, like I said, everyone is hungry, and especially from a market side, they're waiting for Fed to cut down the rates, and anything that can come in its way, whether it is good economy, whether it is strong economy, better jobs, more people going to work, it means Fed is not going to pivot. They still want to control inflation. Markets will fall. James says markets has crashed a few months after most Fed pivots. Yeah, and this is a story that we have seen time and time again. Is Fed has not pivoted, but market will bring in a narrative. They'll pick up the words from any interview and think, okay, it's going to pivot. We'll see 2 days, 3 days of rally, and then the market will start to go back and continue its bear movement. Wow, market is unhappy that wages and jobs went up. Yes, that's what. Right? Good news for the economy is bad news for market. It means you're not gonna get a help from your uncle Fed. They're not, because hey, economy is sustaining itself. Anyway, so like I said, we have seen this story before. So way back in March, market jump up 11%. This one was probably the most prominent, which started from June to August, was a previous bear market. This is called bear market rallies, even though the overall trend is still down. But yeah, so overall trend is still down. But during these, we do see these jumps, so-called bear market rallies. And this is the third one that, at least now we are seeing from October lows, it's up, what, 16%? Oops, yeah, 14% from October low. Is it going to crash again? I have no idea. There are so many variables in the market. We are already in the December, and generally it is said that December second half, if the market changes the December second half, right? That's where the center rally comes in. It also said that in the December second half is where the tax loss harvesting happens, right? Depending on which variable is stronger, we'll see where market goes. And nowadays the Fed is also in the picture. So absolutely impossible to predict where the market will go. But we have seen this story earlier also. So, but I do want to talk about the S&P 500. Right, on Wednesday was, I think 11/30th was Wednesday, which was the last month of November. If we just look at the November performance of S&P, it was up almost 5.5% from a start of November till the end of November. And of that 5.5%, 3.1% came on the last day, which is Wednesday. So that's why it is impossible to time the market. Right? If we have not been in the market and waiting for market to sound a gong, then someone will come and ring the bell saying, okay, I bottomed out. Please, put in your cash that you've been holding on the side. If you're waiting for that, that's never going to happen. Majority of these, the money gets made in these small bear market rallies. That's why I'm still invested in it, in the market. Continue to reduce the cost basis, because I can't predict what's going to happen next week, what's going to happen on a particular day. Yeah. Last week, at least, the best thing that I saw in the markets was China. It's a lot of optimism coming out of China. Hopefully, market hopes that the Chinese government will pivot from their zero COVID policy. Right? There are also some pivoting going on, hopes of pivoting, and we saw some positive signs. But again, you can't rely on Chinese government. Government will do what they want to do, but at least some positive signs came that they may pull back from their current approach of dealing with virus.
May I update you?
Sure, go ahead.
Yes, they are pulling back that people don't have to take so many tests, but as a result, a lot of people got fired. The people who used to the guards of the lines and the people, they closed a lot of those places to get testing.
Mm-hmm.
So as a result, well, because they're not having as much testing, but as a result, people got lost their jobs.
That's true, but I think that would be temporary, because if economy opens, so if China opens up and doesn't have the same restrictions, there will be other jobs they can find. Those jobs will be replaced by other jobs. Yeah, I mean, I'm with you. At least I read the news was that they have relaxed some of those COVID restrictions. For example, if someone is mild, tested positive, and if you're not an elderly person, if you're in a low risk category, now those people are allowed to quarantine at home, right? Um, People in the developed countries in US can't even think of, some of the draconian measures that Chinese government had was, if you are tested positive, you actually have to go to government controlled facility for quarantine, right? You're not allowed to go back home. You're not allowed to go back to your community, to back to your family. So the fact that it's now they're allowing people to isolate at home for a week, it's a positive news for China. This is pivot. This is relaxation of the rules. Also, I think they are looking to speed up the vaccination for elderly, because still elderly people, I think above the rate of vaccination is around 60% only, as compared to 95% in US, and those are the high risk category. So there was some news around the members of CCP Politburo members talking about how they plan to speed up the vaccination for elderly. It means market is hopeful that once the vaccination, the more and more high risk people get vaccinated, that means China will start to relax some of those COVID rules. So that was a big positive news, and optimism for definitely for a lot of Chinese stocks. And I do hold Chinese stocks in my portfolio, with a full disclaimer that there is always a geopolitical risk, but so position size it accordingly, and I'm okay to still hold them. But of course, a lot of Chinese ADRs got boosted by this news. And number two is a lot of other companies in US, because many companies in US have huge dependency on China. Either they are, China is the factory to the world, so all of them were, if it opens up, it'll basically be good for those companies. Number two, China is also big customer segment for a lot of US companies. So companies like Nike, Starbucks, Apple, they have a big dependency on China. So hopefully if China opens up, and then it'll be good. But right now, these changes in the policy are limited. They're doing it on a pilot basis on one or two provinces. Then they will roll it out. So it's a good start. That's what market is. And like I said, market is desperate for any hint of a good news. And we saw a lot of these Chinese ADRs, like and NEO was up. Okay, so I should have taken the 5-day. It was up almost more than 20% in last 5 days. Other NEO is the EV car maker. Another EV car maker was up 60% in a week. Right? Alibaba doesn't need any introduction. One of the is the so-called the Amazon of China. On the same lines, marketplace, e-commerce, Alibaba Cloud. This stock has been beaten for last 2 years. Its all-time high was around $300. Is still down, 2/3, but was up 20% for the week. So we saw a lot of Chinese-related stocks. Baidu, the biggest search engine in China, is up 22%. Tencent, the gaming company, investment company, is up 11% for the week. And this is a ETF, Chinese Internet ETF, was up almost 23%. The reason I picked up these are because these are my Chinese holdings in my portfolio. I'm sure there are a lot of other stocks which also had a great run. Some of the stocks that people generally talk about is JD.com. I used to hold JD, I no longer have in my portfolio. So how JD was up 20%. Again, JD is another e-commerce company. Group buying company PDD, Pinduoduo. How did that do? Up 16%. So overall, I think Chinese stocks, it was a good week for the Chinese stocks. FXI is equivalent of SPY, but this is China focused, large cap ETF, again, 13%, 14%. So one part of a portfolio that did wonderfully good is Chinese stocks. But again, a lot of geopolitical risk remains. We don't know when the Chinese government may change its decision. So this is always volatile. And the other fact is, between US and China, there's always tension going on. So be careful. Overall indices, even though we saw some good gains, but market is still, NASDAQ is still down 27% and S&P is down almost 15%, right? Will we be able to close S&P at least positive or neutral for this year? Maybe not. I don't know. How much of Santa rally can we get in next 25 days, right? And out of 25 days, maybe 17, 18 trading days. So we'll see, but hopefully we can, all write off 2022, forget about it, and then welcome 2023. S&P Sector Overview. Yeah, communication services, discretionary are the ones wherein these are the risk on sectors. And once we heard Fed pivoting or not increasing the rates at the same pace, we saw a lot of, those risk on sectors gaining momentum. And the fear and greed index needle has now moved from neutral into so-called greed segment. This is where we, where is that? Our bear market rally charts, right? I believe over here it was around that read. The meter was around 75. So now it's back into the greed segment. The other thing that I heard a lot of people talking about is on the bear market rallies. And I am not a big technical chartist. So someone else who probably is more focus more on the technicals can correct me or provide more information. But what I heard was when it comes to the bear market rallies, the 200 moving average indicator is something that we need to keep an eye on. If it stays above 200 moving average, which is this teal color, if right now the market was barely up and then it's right at the cusp of 200 moving average, we have seen this average became it was a strong resistance on August rally. It couldn't breach it, so we saw another decline. It breached in around May, but then again fell down below 200 moving average. So some pundits are predicting if the market can stay above for 200 moving average for at least a week, then we should see Santa rally at the end of a year. We should close the year with a Santa rally, means the market could go up. On the contrary, if it cannot keep its momentum and stay above 200 moving average and moves into other direction, then we should see the same pattern being followed, which is our bear market rally. We should see weakness in the markets. And depending on who you listen to, different there are the estimates of how how further the market could fall varies a lot. I've heard numbers around the bottom of the market will be around 320, will be around 320. Right? So right now, what S&P is close to 400. Right? So it means another 20% downside is, still is within the realm of possibility. Or other people say maybe, market won't bottom out until it falls another 20%. Right? Who knows? But many of these people have had credentials, have been in the markets way longer than I have been. But I'm on the firm faith that everyone have their guesses. No one knows what's going to happen. So I'm not going to make any drastic changes. Okay. All right. So that's around a little bit of a technical chart, which is, generally, I don't look at the technicals too much. I see one comment this week. One student was tested, and all grades were asked to stay home and attend Zoom class. I don't know. Is this comment for someone in China or is it comment in someone in US? Especially in the US, we are seeing a lot more cases in China. Okay. Yeah. So China has the number of cases in China, the COVID cases in China has just erupted. I think was it last Sunday? But it was the maximum number of COVID cases reported since April 2022, right? Even on the US side, we are seeing a lot more COVID cases being reported. I don't want to, venture too far. My own daughter, she tested positive on Thursday. She was like feeling under the weather, and I was taking her to her classes and all that. And then on Thursday, she tested and said, "Dad, I'm positive." I'm like, "Whatever, stay in your room, and things will be okay." So she doesn't have any other symptoms, no fever, etc. But you use that home kit, and she has tested positive.
Vivek,
She earned the badge because in my home till date, I was the only one who had gone down on COVID. Now she said, "Okay, I also went through this." Yeah, there was some comment.
yeah, when I was came back in last year in January, the front desk clerk had COVID. Maybe a couple of front desk clerks had COVID, and fellow neighbors had COVID. For me, I had just come back from Hong Kong, where actually you're thrown into quarantine centers in the beginning, and if you have COVID, you definitely go to the hospital. And so I was really taken aback at, it's ridiculous. And then we have this anti-China discrimination.
Yeah. So I mean, at least in US now, we are all especially after the vaccinations, we've become a little relaxed, and I think and especially right now, there is COVID, there is flu, and there is another virus, some R2 or something, which is very prevalent. So stuff is same, right? When I contracted COVID, I didn't go to hospital. And we'll see. A good part is because of vaccinations, the impact or the effect is not severe. The people just recover at home. Unfortunately, I think in China, the government has a different policy. Here, the policy is they will say, "Don't even come to hospital. They're like, stay at home." In fact, when I contracted COVID, I called up my doctor and I spoke to them. At what point should I come to hospital? And I will measure that oxygen concentration in a blood. You have that, I forgot the name, oximeter. But what point should I call up hospital? And they told me if you're difficult in breathing, etc. I'm like, okay, I don't have anything like that. I had fever and for 2 days, and then I was okay. Yeah. But I think right now, again, we all had predicted it, that once we open up the economy and it come winter, wherein we have more occurrences of all different type of viruses, we should see a flare up. But so far, so good. Things are under control. So at least not worried right now. Some other interesting charts, Fed balance sheet. Okay. Oh, the RSV. Yeah, there was this new RSV is coming. Okay, little pivot from this one. There was an article, I didn't read the fully, but I just read the headlines today morning. Is under Serbia permafrost, they have discovered some 10 new strains of viruses that world never knew. Now, those have been in the permafrost for thousands of years, but they are still potent. And I was like, who is going and disturbing those viruses under permafrost? Leave them there. And the article said that we do not have any, and some of them could be even deadlier than the COVID ones. I'm like, gosh, who's going and digging under the Serbia permafrost? But that was a news, a headline I read today morning. Anyway, coming back to finance, Fed balance sheet, we start to see the curve going down. Lot more to cover. This is 2020. The balance sheet was around $5 trillion. We almost doubled it from 5 to 9. Now we still have $4 trillion to lose or to reduce the balance sheet before we get back to pre-COVID level. So those are saying, hey, the recession, it's not over yet. Yeah, could be, because still a lot of, the balance sheet is still bloated. We still have to clean up these extra assets on Fed balance sheet. Yield curve, if there is only any reliable predictor of recession, it is the yield curve. Again, still the most inverted over the last, this is from 18. Okay, so since this is, I think, most inverted over the last 20 years. With thoughts around that, the impact of Fed increasing the rates will start to show up in 2023 earnings, and that's where we should see full recession. Maybe yield curve is the predictor of recession. That after the inversion, the recession start to set in between 12 to 18 months. So started inverting somewhere in June, July. So we'll see. Right. 30-year mortgage, little bit tapering on that, but still way higher than where it was. That means the number of, I don't have a chart, but I think there was again headline on the number of home listings has reduced by 35% as compared to last year, because there are people are not buying homes. So and those who want to sell, they're not selling, because if you sell and then you have to buy another one, who's going to pay 6%, 7% mortgage if your current mortgage is 3%, 4%, right? Anyone who would have refinanced in 2020, 2021 is probably paying, less than 4%. So even if you are you want to, let's say, move to a bigger house, or for that matter, to smaller one, if you don't have a good enough cash to, if you, after selling the house, if you still need to take on a mortgage, it's brutal. No one wants to pay off 4% and then take another mortgage at 7%. So the home listings have come down 35% as compared to last year. All right. Oh, the next one. Yeah. So this is our first session after the end of November. And as always, the trend is that I do share what I hold in my portfolio. So as of end of November, again, I just want to be transparent because we do talk about stocks. So I want to be transparent and share with you what I hold in my portfolio. So you can decide when I'm saying I'm bullish, is it I have a cognitive bias, or there are some facts on why I'm bullish. So still 71 long stocks in portfolio. Not much of a change, except Shopify has broken into top 10, and no surprises over there. If you look, Shopify has been on some good run for over the last 1 month. If you look at, it's been from 34, it's been almost up 28%. So that propelled Shopify to come back in top 10 and, pushed out Airbnb. Other than that, I think there's just a rearranging of the top players. So cash is still top, SPY, Apple, Melly, looks like Microsoft on Amazon, they switched places. And then ASML. ASML had some good run up again. It was around from 400 to 420, I guess, to now it is almost 600 plus in a month. Yeah, around what, 440 to up 40%. So that brings it up higher in the ranking. And then Amazon Gold had some good run. Surprised. So gold was up what, almost 10% in November. Let's go back and look at it. Yes, exactly, almost 10%. After a long time, gold has been testing a lot of patience. So still for year to date, it's still down. Almost, let's say, come back to where it started, but it's been range bound for quite some time. And Google is Google, not a big change. So that's on the change in the portfolio. I don't think I bought any new takers. Nope. All right. So yeah, also quickly wanted to talk about place for cash. If you're waiting on the sidelines or want to systematically invest and not go all in, and so what do you do with the cash? So there are a few things that we can do. And I was just talking to my own kid, my elder one, and saying, what do you want to do with the cash? Kids being kids, he said, Dad, I need all my money. That's great. Keep it whatever you need for next 6 months in your bank account. What do you want to do with the others? And so after a few, finally she opened a savings account. I want her to do it, and I don't want to do it myself because I want her to learn some of the stuff. So what do you do for a cash? Number one is high. Of course, you can keep in your checking account for your regular expenses. That's what we all do. The other option is high yield savings account. I would say all those big banks, Bank of America's or those money center banks, those are worthless when it comes to paying anything for generating any yield on savings account. So if you want to go and generate some yield on savings account, you can compare out on bankrate.com. The more of online banks, they give much better rate than these big money center banks. So right now, just on the savings account, the rates are pretty attractive, right? So 3% is a pretty easy to get into a savings account, right? Your checking account gives you nothing, it's 0%. So we don't need it for next 3 months, 4 months, 6 months. It's a quick, easy 10 minutes opening an account on any of, you can go to bankrate.com and check for it. But again, my favorite one is LI. Favorite because that's what I started with, and this is not a recommendation. I'm not a shareholder of LI. I have no shares of LI, and I don't work for LI. But I started with them 10 years ago, and then I have stuck with them. Right now, they're offering 3% on an online savings account, which also, you can do 6 withdrawal transactions in a month, which I'm like, oh, that's good enough for me. And eventually my kid, she also opened on LA Bank. I asked her to do her own research on bankrate.com. Then, we discussed few of the banks, and then eventually she opened on LA Bank. In any case, that's another option, is 3% not bad. And while you wait, or, while you want to invest small amounts, in the market. Another place to park is 3% on any of Goldman Marcus is good. What other names I saw while I was walking with my daughter? Capital One. These are the big names and reputable names. Plus now there are a lot of other banks, very regional small banks, which offer 3% to 4%. Other option is bank CDs. Yeah, Synchrony Bank offer 3%. Synchrony Bank is also a good bank. I mean, this is a bank which is behind many of these what do you call store cards that you buy. Many of them, the bank that the bank with is Synchrony Bank. So again, that's not bank that will disappear. So Synchrony Bank is also good. Okay, go to bankrate.com and you can find out a list. The other option. So now if you're looking at it, this is more liquid, means ready access to your funds, and the rates, right? So checking account, 100% accessible. You can withdraw as much as you want to, how many transactions you want to in a month. There is no limitation, right? But it pays nothing. High yield savings account, there is some limitation, but then it pays some decent rate, right? You want to get higher rate, you'll see a little more limitations around it. So you can open up a certificate of deposit with banks, 1 year, 2 year, they all are paying, at anywhere between 3% and higher. So let me go to bankrate.com. Let's look at CD rates. What do they do? Yeah, 4%, 4.75% for 1 year. Synchrony pays 4.75 for 19 months. BMO again, no name. Marcus by Goldman, again a no name. Even though the Goldman is trying to now wind up this whole Marcus brand, they want to what's the right way? Disinvest from Marcus, but they will basically sell this whole business to some other regular bank. But from as a depositor, your funds will still be protected. This is what I hate, right? Wells Fargo, Bank of America, these money center banks don't pay anything. So yeah, decent 4% rate if you want to open up a CD, but then you can't touch before the term, or if you touch, or if you withdraw it, you may have to pay a penalty and you may have to forego our interest rate for a few months, right? So access to funds a little less. There is always a risk and the reward. The reward is you earn higher interest, and the sacrifice is that if you withdraw it before maturity, you may have to pay a penalty, right? Next is also government bonds, bills and the notes. We talked about some of the previous sessions. We spent a lot of time on this one, so I'm not going to go in details on this. Again, the accessibility, you buy or selling is needs little more effort than what you can do by opening a bank CD, etc. But they pay higher interest than what you get in a bank CD or in your savings account. Because at the end of the day, the way these banks are able to offer these CDs or higher interest rate is because they also turn around and buy the government bonds, bills and the notes, and they make, let's say, 4% on it, and they'll give us 3.75%, right? So you can buy this on Treasury Direct, you can buy these on your brokerage platforms. And I think I have one more article. I see more and more people in the in financial media talking about no bonds, because the interest rates are very, very attractive, right? If you look at it, it's like a 4% interest rates. So recent auction results, look at 4-week, you have an APY of like 4.014%. Now, if you're doing for 1 year, 4.78%, The reason why, let's say, Capital One is able to give you 4% on 1-year CD is Capital will come and invest here, and they'll just make the spread. So this is another one. If you have a 4-week, 8-week, 13-week, 17-week. As you know, I have my ladder on T-bills. Other one is money market funds. This is, again, you can buy on through your banks. You can buy it through a brokerage. Can pretty safe investment. Again, more readily available from a liquidity perspective. Next is a corporate bonds. It's a higher on the risk front, because then you have to be careful in terms of which corporate bond you want to buy. And then again, there are ETFs that you can buy which invest in corporate bonds. There are high yield corporate bonds. There are junk bonds. That means they have the junk bonds have higher yield, but then the risk is also higher. There was a question on where can I buy corporate bonds from? You should be able to buy it on your brokerage account. I think you can buy bonds and fixed income. Okay, so I think I may have to log in because I don't see it here, but these are available. You should be able to buy these in your trading account. Other thing is there are ETFs which invest in corporate bonds, ETFs, right? So if you want to pick up, you can pick up any of these ETFs from these issuers, right? Ally, Wisdom Tree, not Ally, Vanguard, Wisdom Tree, Fidelities, State Street, etc. So these are the ways in which you can buy corporate bonds. Again, buying, let's say, corporate bond for Apple is as safe as, let's say, US Treasury, but go and buy a corporate bond for AMC because AMC is offering us 8%, the risk. And going further on the risk spectrum is give unsecured loans to crypto lenders. A lot of people have learned the lesson. Some lenders were offering 20%. Now all of them are bankrupt. So again, higher the risk, higher the return. The reason that 16% is because those are unsecured. And then there are, nowadays I get email around investment opportunities on some of the projects, right? And I'm like, okay, no, I'm still not doing venture investing right now. So I don't want to put my money over there, but I'd rather do right now in the public markets. But yeah, higher on the risk spectrum, higher the return. So be careful on what your risk tolerance is, and then park your money accordingly. So I think this one has completely gone bust around the crypto lenders, but there are a lot of other normal lenders in a regular economy that you can lend to, but those will be unsecured loans, right? One of my friend has raised money for his real estate, right? He had to pay 10%, but it was like unsecured. So higher the risk, higher is the amount, higher is the return. WHA, kids don't want cash anymore, they want Robux. That didn't translate into Roblox results though, but I'll be happy if that's the case, right? Next phase of our life gonna be all metaverse, all gonna be kids spending more time on online world. We'll see. They used to, 2020, everyone was on Roblox. Now the kids are going back to school, but I think that trend is here to stay. And so since we're talking about bond, and as you guys know, I had already started my bond ladder, and then I saw this is like balance of November 28th, so pretty recent. Now everyone is talking how to build a bond ladder with around 4 to 5% yield, right? So think hold on. Let me see if I have that. I had that visual of the bond ladder. Let me just pull up if I still have it. Okay, this one. Right. So this is what I had started off, is having 17-week of bond ladder, right? 4 week, next is 8 weeks. So basically the ladder means you buy, and you could do with anything. You can do with the CDs, you can do with the corporate bonds, you can do with anything. But what I did was for the treasury bills is create a ladder for 17 weeks. 17 weeks is around your 4 months. Give me visibility and give me a liquidity for every 4 weeks to go back and see if I want to invest or do whatever I want to do. But for the money that's been lying on the side, 4%, 3%, not bad. So buy ladder is around the maximum duration is 17 weeks, starting with 4, 8, 13, 17. The 4 one is already matured, so that I renewed for the 17 weeks, which is will go till Feb. Now in December, in another 2 weeks, another one is getting matured. We'll see. Some of it I can put back in the market, some I can reinvest in for 17 weeks. So the idea of building the ladder is that you can continue to get a higher percentage, right? If we're going back to the still here, so if you look at it, if I do 4 weeks, you get 3.95%, but if you do 17 weeks, you get 4.558%, right? So the objective behind building the ladder is you get high return, but then you have access to money at a regular interval as one of the legs of the ladder expires. So I think everyone wants to do it. So this week saw a good article on Barron talking about the concept is straightforward, right? You assemble a portfolio of individual bonds that mature at a regular interval, reinvest the principal in a new longer term holding when the nearest term bond matures, right? Same thing, this is, which was when this matures, reinvest it for a longer term. So now in, rather 4 weeks, after the first ladder is completed, everyone is earning each of the legs are earning higher interest. This is pretty common concept in a lot of people use in CDs. Bonds were not paying anything, but now the bonds are paying. So you see more and more people talking about building bond ladders, right? There were questions on corporate bonds. So this one does talk about some corporate bonds. So you got Invesco Bullet Shares 2023 Corporate Bond ETF BSCN. Right, then there is 2025 bond is BSCP, means it matures in 2025, it matures in 2024. As I mentioned in some of previous sessions, if you're investing any of these bonds, make sure you can hold it till maturity, because in between anything could happen. And again, this was validated. I feel vindicated, because they also talk about the same thing is, if you hold the bond to maturity, it does not default, you'll get a return that you bargained for. But if you do not want to hold the bond till maturity, then depending on how the interest rate moves in future, your bond may not pay you what you thought it would, right? That's a lot of people get surprises. They thought bonds is the safest instrument, and you don't lose money on bonds, but that is if you can hold it till maturity. So if you're picking up the durations of investing in the bonds, then make sure to pick a duration for which you are okay to hold for the whole duration. In between, you can make more than what you had thought, or you can make even less than what you have thought. That depends on how the Fed changes its interest rates. So that's all around the bonds. A lot more people talk about ladders now. See a comment, Ramesh, TOS account being moved to Schwab. Yes, I got an email from them that they started the movements of moving the accounts to Schwab, but Thinkorswim platform will still be there. If they kill Thinkorswim, then I may have to find a new broker. Right. Another interesting chart, work from home. This shows the gap between job applicants which are looking for work from home. 50% of job applicants are looking for work from home opportunities, whereas the job postings that are offering work from home or remote work is only 15%. So there's a big gap. Now the bigger question is this 50% comes down to 15% or the 15% goes up in the direction of 50%? Given the situation right now, I think this 15%, the 50 is going to come down. Right now, I think it's especially when it comes to these jobs which are more tech oriented. A lot of those physical and service jobs you can't do from home. Right? Right now, given the situation in the market, especially on the tech sector, it's not employees market, right? It is employers market. We saw DoorDash laying off 15%. And I mean, every week we see one or the other company laying off people. So it's a bad when it comes to the tech jobs. But service jobs still pretty strong. Unemployment rate like 3.97%. More jobs added, but all those were mostly around the services side. Other interesting one is Apple's 30% tax on NFTs. This is surprising. Looks like Apple doesn't understand how the whole ecosystem works when it comes to your blockchains and NFTs and the gas prices and all that. But there was a series of tweets from a Coinbase. It was interesting, so I thought I'll share this here. Apple's claim is that the gas fee required. So whenever you send any NFTs or transfer any digital assets like these Bitcoins or any of these, you got to pay the gas fee. That's a toll for using the blockchain. And what Apple's consider this as, as an in-app payment. And per the terms and conditions of your app store, if you are having any in-app payment, Apple takes 30% haircut. I think this is one area where I get a little concerned about Apple's hegemony. I don't know, regulators might come back, come and try to restrict Apple, because this particular subject has been bubbling up, across the industry. We saw this tussle with Epic Games, now even with the Coinbase. Yeah, Sam.
So how does this affect Twitter? I mean, I downloaded for free. So does Apple get Twitter's advertising money or something?
No. So no, not the advertising money. But let's say if Twitter has a subscription service. Let's take an example of Netflix. So if you download Netflix app on your iPad, and then you sign up with a Netflix and pay through it on your app, Apple will take 30% out of it. But if you go to netflix.com on your browser, and you basically sign up over there and pay on that, and on your, then Apple won't take it. So that's what the Epic Games did. So Epic Games, when you do an in-app purchases, mostly in the games, you have a lot of these in-app purchases. You want to buy a new skin, you want to buy a new weapon, whatnot, or a new lifeline drugs, which will give you extra lives. So Epic Games, the creator of Fortnite, I mean, they popularized it. They were the pioneer in the whole concept of download the game for free, play it for free, but they make money when you do in-app purchases. And Apple was taking a haircut, 30% haircut, was giving 30% haircut to Epic Games because they were, charging 30%. So what Epic Games did was to create another route wherein they'll give you a link And if you click on that, you go to a different payment system, not pay through Apple. And then there was a, Apple says, oh, we're not gonna, we'll basically take Fortnite off our app store. You can't do that. And that's where there's a whole, this was started 3 years ago, a legal tussle between Epic Games and Apple. And now we are seeing, Coinbase also talking about it. This is a monopoly. And this is one area where a lot of these companies are going to regulators and saying, because Apple control this ecosystem and they are, they have a monopoly on this app ecosystem, and they're basically squeezing all the app developers. Apple to its justifies it, saying we are only charging 30% for developers that make more than $1 million. So it's not the small developers, or it's not that we are curbing innovation, we are hurting innovation. Or those developers, small ones, they charge only 10%. So these are negotiable. I also know of another company which I think negotiated to 10% or 15%. So yeah, but this is one area where I think regulators might look at is 30% surcharge, which goes into Apple pocket. So anyway, now surprisingly, it's a Coinbase. Apple's updated their terms and service, saying if you are sending NFTs, because now these crypto exchanges have their apps, and on those crypto exchanges you can send NFTs, buy NFTs. So if you are transferring NFTs, you're paying a gas fee, and Apple said that we want to collect the 30% of the gas fee. Fortunately, for anyone who understands how NFTs work, this is not even possible, because the Apple, you can't pay the gas fee using Apple payment rail, right? So even if they want to do it, you can't comply with it. So it says this is akin to Apple trying to take a cut of fee for every email that gets sent over open internet protocols. Or I would say this is equivalent to if I have a TD Ameritrade app on my phone, and then buy and sell, and TD Ameritrade make money on those buy and sell, and Apple says I want 30%. So this basically has taken, the crypto developers and the crypto the ecosystem is now up against Apple. So for now, the Coinbase have disabled the ability to transfer NFTs for the users. So those who held their NFTs on Coinbase wallet, now they're stuck because they can't, sell it or they can't transfer it, or they can't sell it to anyone. So yeah, we'll see. But Apple being Apple is, wants to show who the boss is. Other interesting thing around Apple, and this is, I'm more bullish, this is more positive news. I'm a little scared on this one, is, this is anti-competitive, give more fodder to anti-competitive narrative. But this one is, and this is not a surprise. We've been talking about Apple's investment or Apple's experiments into AR, VR has been happening for quite some time. And Apple being secretive, you don't get to hear it so soon, but now slowly and steadily the news is coming out. So Apple plan to introduce the new headset maybe early next year, and they've changed the operating system name from Reality OS to XR OS, which is extended reality, because it's not going to be VR, it's going to be the combination of AR and VR. So probably this may be the next big thing since Apple Watch, right? So after Apple Watch, there is nothing new that has come out of Apple's table right now. Apple Car, I don't know when that will come out. VR, AR, seems that probably is closer based on this article. So that's going to be the next big thing for Apple. And knowing Apple, they have generated what wearable business is now $40 billion worth. Right? This could add a lot more to this particular business segment. So This device will offer virtual collaboration tool and a VR version of FaceTime, rivaling, services like Zoom and Meta Horizon Workrooms. So I am a Meta shareholder. So I have a mixed feeling with this. Number one, does it, validate the Meta strategy around VR and AR and, metaverse? Because now it's not only Meta, Apple is also moving into this with a combination of their AR VR headset or AR VR tool. So maybe there is something to it, whether we like it or not. These things could become reality, right? Or virtual reality in coming future. So keep an eye on this one. This may be maybe the next big thing from Apple. What else? Yeah, the other thing which caught my eye was mysterious death across the globe of crypto millionaires. So we saw again one of them died in helicopter crash, another one died in his sleep, and the third one was drowned in Puerto Rico after he tweeted saying CIA and he fears for his life from CIA and Mossad. Helicopter death is on very clean weather, very experienced pilot. No one knows why it crashed. So we don't know what's happening. What's happening in this world? There are too many things are happening on the crypto world. It's seeping into the normal ones. We saw Sam Bankman-Fried getting a lot of airtime after the deal book symposium. Now he's on his media tour of public apologies / public sympathy. New York Times and Wall Street Journal have become very sympathetic to a scammer. I don't know why, but yeah, they're getting a lot more airtime. At the end of the day, you're just a scammer. Should be dealt like one. I don't know why Andrew Ross Sorkin, New York Times, and Wall Street are being being soft on Sam Bankman-Fried. But in any case, some mysterious stuff happening on the crypto world. All right, what we are close to 11:20. Maybe I'll skip this. Two things. Want to talk about hedging first or the quantum computing? Meanwhile, I'll sip some water. Let me know which one should we start with. Any choices? Preferences? Okay, I got one vote for hedging. No wonder voter participation rate is very low in the US. All right, everyone wants to, then we'll flow with what others says. Okay, got 2 votes on hedging. So let's start with hedging. Okay, why do we want to hedge? Let me ask a question. Do you want to hedge if you're bearish about the market? Or do you want to hedge if you're bullish about the market? What's your thought? Who should hedge? So if I'm bearish about the market, should I put on a hedge? If you are bearish, would you put on a hedge? I see an answer, yes. Does anyone says that SP and Bob are wrong? Anyone has a different opinion saying if you're bearish about the market, hedges is not for people with a bearish views? Does anyone hold that opinion? Or am I the only one? Okay, SP says, oh, you should hedge in any direction. So here's my thought. I would hedge if I'm bullish on market, right? But I'm nervous about it in a short term, right? If I'm bearish about market, the best is to get out of market, right? I'm an optimist by nature. I am bullish about market. I am bullish about human ingenuity. I am bullish about the companies that I own in my portfolio. And I know those companies will continue to do great things. We will see eventually how it happens, but that's the reason why I own them, right? So I am bullish about it, but I'm nervous, right? So that's the reason why I need to hedge. If I'm bearish about a company, if I say, oh, I don't think this company is going to do good, the CEO sucks, the management, there is accounting irregularities, they lost the moat, then I won't be hedging it. Then I'll just sell the company and then get out of that company. So James says, hedge, it's an insurance. Yes. So if you're an insurance, you still love your car, right? You don't buy insurance because you just want to throw away your car. You just want to total your car, and hence you're buying insurance, right? So yes, I still love my car. I am long term, I want to hold my car, but I buy an insurance because I'm a little nervous, someone can come and hit me. So same is the case with portfolio. Is I am bullish about the market. I'm bullish about the companies that I own, but I'm nervous about it right now. And hence I need to have some hedging in place to take care or to help me to continue on that company and overcome my nervousness, right? So that's first. Many people think if you're bearish, you should hedge. No, if you're bearish, you should just sell. All right. And this week, we also saw a lot of active managers are adding, to their hedging positions. Option market show a trend towards hedging. I've been hedging since 20. I always have some level of hedge because I'm bullish about the market. Beyond the institutional circles, then we see a lot of demand from AMC, blah, blah, blah. So why you should hedge when you're bearish? No, you should hedge if you're bullish about the market, but you are nervous about the market. So easiest one to hedge is buy a put. Right? Let me ask anyone over here who have not traded options. Then maybe I'll talk about a little bit about calls and puts. James, yeah, put call ratio will tell if if hedging is going on. Yeah, you can find a difference between, whether there are more puts versus calls. There are different ways. Again, I think there was one digital article we reviewed a while ago. It doesn't always tell you. So there is no clear-cut signs which will tell you, if the put call ratio is going higher, it means a lot of people are hedging. Again, different interpretation, right? So what does put do? So I'll quickly start with the base. What does put do? Put gives you a right to sell the underlying at the strike price, right? So let's start with the hedging stuff. Say I own, let's close this. I'll start with my portfolio. Say I own 100 shares of SPY, which is a market ETF, and that's my only portfolio. This is the only thing that I own in my portfolio, right? I bought it at 400, whatever, $406, which is where it is currently. I am bullish about the market, but I am a little nervous, saying what if in short-term market may crash, I may want to hedge. Now, most of the retail investors will do is the easiest one, that you give yourself a right to sell the SPY at a certain price, right? So you could go and buy a put. Say if I want to buy a put at 400, or which one did I have mentioned here? 400. Okay, let's do it. I'm saying I bought the stock at $406, right? And I want to have a right to sell it at $400, irrespective of where the market goes, right? So then you go and buy a $400 put, which gives me a right to sell the SPY which I'm holding in my portfolio for $400. even though the SPY could have gone to 320, right? Like some of, I don't know, Stanley Druckenmiller or whichever one says, market hasn't bottomed out. Market will bottom at 330, 320. So don't care if SPY goes to 320, 330. I will be able to sell it at 400. I want that right. I can buy a put. But for that, right, I have to pay. There is nothing free. I have to pay, let's say, $1.60. And I have this right for next 48 days till 20th January 23. If I want to protect for longer term, I can come down, let's say 30, let's say March for next 100 days. Right? Maybe I think right now the Santa rally will be there. Maybe in January, February, market will tank then in February. So I want to have protection till end of March. All right, we'll choose end of March. And say you want to have a protection for your 400. You can buy a put for 400, but you have to pay higher amount, because now this is like you have your insurance contract, which is valid for, instead of 1 month, now it is valid for 3 months. So now you have to pay, more upfront as a premium out of your pocket. But if you do that, doesn't matter where the market goes. If your portfolio, you're not gonna lose more money, even, beyond, 400. And of course, the initial premium that you paid, which is your, in insurance terms, this becomes your, missing the word, deductible, right? The $14 is your deductible, and that's what you're paid upfront. Beyond that, everything gets covered, right? So this is how your portfolio would be. Now, the question is, if you want it, not, there is a cost for this. So this is the easiest one, which is buy a put, but there's a cost that you have to pay. Now, if you're looking at a cost, right, for next 48 days or 50 days, which is January 23, you are paying $8.50, which is almost 2% of the current price of $406. Right? So you're paying 2% of the value to protect your portfolio for next 50 days. January is, 48 days, next 50 days. That cost is high. Okay. So how do you reduce the cost? Right. The other option is you buy, instead of buying a put, you convert that into put spread. So I'll just stay with this 48 days, right? Put spread means your protection starts at 400, right? Because you think, yeah, $4, $5 loss I can bear. I want protection beyond that. So your protection starts at 400, but you think the market won't go down, below 350, right? Or let's say 380. So you buy 400 put and sell 380 put. This becomes a put spread, right? If you individually look at it, let's ignore everything else. All right, this is your puts, put spread. Is you buy a 400 put and sell 380 put, right? So what happens in this case? If the market comes down, your protection kicks in. See, the red color shows what's the value would be, right? You're not losing anything more than 1,094, but your protection expires beyond 380, right? Because now you don't have any more protection beyond 380. Now you can pick and choose, say, what's your outlook towards the market is. You think, oh, I think it could actually go down further than 380, and you want to protect your portfolio for, say, till 370. You could do that, but then you have to pay higher. So the only difference is selling this put reduces the cost of the insurance that you were trying to buy. So without the insurance, without the put spread, just a naked put, that's what it's called, it'll cost you $8.60 to get a protection, but it will protect you even if the S&P goes to $300, right? But come on. I know times are bad. You know times are bad, but do you think S&P will fall to $300? No. In next 60 days? Probably not. So if you think you don't need protection all the way till $300, but maybe you need it only till 370 because you think the market will bottom out at 370 or won't fall below 370 next 60 days, then why you want to pay for extra protection below 370? Right? So that's where you introduce this put spread, which means it will cover you from your 400 all the way till 370, which is what you think. That's where the market could fall. But if the market goes further down, then you incur more losses. Now, the benefit of this is your upfront cost is less. Instead of paying $8.60, you are paying $6.30. It's still expensive, right? $6.30 will give you protection till so it is 370, right? So which is marketed as 400. 370 means 10% down in the market. Well, close to, let's say 10%, right? A little less. So it will protect you for market crashing 10% by mid of Jan. Right? But then the cost is less. For 10% protection, you are paying $6, which is almost 1.5% of the value, right? Which is still on the higher side. So we'll figure out the other ways of putting these other hedges, right? So these are very common ways that I see people, mostly the retail investors using is buy put or buy put spread. I don't do any of these. Like I said, Ramesh said, I don't believe in buying puts, collect less and be happy. Because long term, this strategy doesn't work. It's super, super expensive. You're trying to protect an asset which appreciates 10% on an average per year. And if you're buying a protection and you're paying even if 1.5%, or in this case, like 3% for next 60 days, means 2 months. So that becomes 3% for 2 months means 18% per year. Doesn't make any sense. Why would I pay 18%? Or in this case, why would I pay 9% to protect an asset that generally appreciates 9% in a year? So that's why this is, a lot of retail investors will do it. People who get into options will talk about how, hey, let's buy puts, but it doesn't work. It's easy, but that's not optimal, right? So we looked at other option is buy a put spread. Third one is put a collar. So let's talk about what the collar is. Right. Again, this is what you hold in your portfolio, S&P 500. Collar is nothing but your stock is at, let's say, 405. You can say, I want to buy a put to, protect myself, let's say after 400, still the same. But then you want to sponsor that. It is super costly. You want to reduce that cost by going and selling a call away from where the stock is currently trading, right? So this is called collar. That means in this case, or in fact, in this case, you are actually getting a credit of 40 cents. You're not paying, but you're actually being participate. So let me just go to bring it, let's say neutral. Okay, all right, this, right? So what I do now, when you look at the call, when you sell a call, you collect a premium, and that premium that you collected reduces the overall cost of buying this protection. But when you sell a call, you are obligated to sell the stock at the strike price. In this case, it is 412. If the stock goes to 412 and expires higher than 412 by January expiration period. So overall, it is good for portfolio because it means the stock has appreciated from 405 to 412. But if stock goes down, which is why you want the protection, you are protected for any further downside beyond the 400. So far with me, any questions, feel free to ask. Right. Now, nothing comes free, right? So what you are paying for, in this case, you are capping your upside gains. So if you don't have this protection, if you only had this put that you bought, in that case, if the market actually, instead of going low, if the market actually starts to go higher, you would have enjoyed that upside momentum in the market. Right? If you had just bought a put. Same is the case if you bought a put spread, you would have enjoyed the upside momentum if the market, instead of going down, actually goes higher. But like I said, this is too expensive. The other way is to put a collar, which is to buy a put, which gives you protection, but you don't want to spend money, so you have to give up something in return. What you're giving up is, if the market goes higher, I don't get to participate any gains beyond 412. Now, 412 is currently is 4. It's let's say 2%. It's 2% higher than where the market currently is. And if you're thinking, oh gosh, maybe market could go up because of Santa Rally, XYZ. I don't want to lose the opportunity to make more money if the market goes higher. Move your strike price to higher. So if you think that it won't go higher than 420, then you pick up your strike price of 420. Well, then you have to pay more for this insurance protection. So this is called collar. Means my stock is here, and I am putting a collar around the stock, in which I will sell the stock if it goes higher than 420, and I'm protected if it goes below 400. So no free lunch. If you're buying that protection, if you don't want to pay, then give your upside gain. So this is third strategy, which is buy put a collar. Okay. All right. So next one, I just want to add, instead of putting a collar, oops, where did we go? Right. Instead of putting a collar, I'm saying maybe we could do a spread on both sides. For example, I know markets, I'm nervous, market could go lower, but I don't think it's going to go beyond 370, right? Like we looked at this put spread. So instead of buying the put, I would say I buy this put spread, going back to the previous example. So which will protect me from all the way downside from 400 all the way till 370. Right? So I think market won't fall more than 10% in next 50 days. Super expensive to get this protection. So now I want to sponsor this protection. One thing we looked at was, okay, you sell a call at say 420. So let's do the 420, you sell a call. Okay, so now I got protection till 370 and I got upside to enjoy till 420. And what I'm paying for this is $1.31 upfront from my pocket, because this one is $6.30. This is almost $5.10. It's a credit. So net debit is $1.20. Right? Which is way better than paying, $8.60 for this protection. But still, my concern is if I'm eternal optimistic, like I am, I don't want to cap my upside gains, right? What if Fed comes on January and says, I'm going to cut the interest rates? Right? Just assume a hypothetical scenario. Or China opens up completely, right? Market could go bonkers in that case. And I don't want to be left out saying, gosh, I didn't enjoy any more gains from 410 to 420, 400 to 420, which is, let's say, 5%. Gosh, I didn't enjoy, my portfolio didn't go higher beyond 5% because I capped myself out. So in that case, instead of selling call, maybe sell a call spread. So convert it into a spread on both sides, right? Again, there is no free lunch. So if you do that, what happens? Now your upfront cost of doing this is $6.30, then let's say $2.70. What does that mean? My math is not that strong. So that makes 30 plus, so that is $3.60. Right? Better than paying $8, you're now paying $3.60, which gives you protection all the for 10% fall in the market. And if the market becomes crazy and continues to go higher beyond 430, you'll enjoy the upside. Right? Between 420 to 430, you won't. That's your cap, but beyond, goes to 440, you'll still be able to enjoy the upside of it. So this one, this also reduces the cost of your upfront insurance, plus also keeps you in the game in case our fear about the markets don't come true. On the contrary, markets just go higher and higher. Okay? So that's another one in which instead of just selling a plain collar, no, this one. Oh, which one was that? Yeah, instead of just doing a plain collar in which I am just buying a put and selling a call, but my upside gains is restricted, you could do a, I'll give it a name, let's say a collar spread, in which you sell a call spread and buy a put spread. Okay. So these are, few combinations that you can use. Now, depending on how much you want to protect. Now, this goes into, like I was saying, this actually 4 hour will take 4 hours to complete every aspect of portfolio hedging, right? How do you know how much you want to hedge? Today, right now, just looked at, you have 100 shares and that's all your portfolio is. Right? But of course, you don't have only SPY. Right? I have a 71 shares in my portfolio. Right? So how do I know which instrument to use for hedge? Should I use SPY? Should I use QQQ? Should I use IWM? So the whole concept of beta and portfolio beta weighted deltas. And then on top of it, I have options, right? So then how do you hedge? Put an overall portfolio hedge. So I'm not getting into details of those, but assuming if you have SPY, this is how you put your hedge. If you don't have SPY, that's where you need to know, okay, I'm having $400,000 worth of portfolio or $100,000 worth of portfolio. That is equivalent to how many SPYs? That if the portfolio that you have is a broad market portfolio, right? Which will be equivalent to, let's say, 250 SPY. Now, how much of that you want to hedge? Do you want to hedge only 100? Then you do one contract. If you want to hedge, say, 200, then you do two contracts. So let's say I had a 200 SPY, right? And now if I'm putting a hedge, I'm putting a hedge because I did only one contract. If the market continues to go lower, I'll still be incurring losses because I'm only hedging one contract. So if you want to hedge, get full hedge, then you have to do for two contracts. So these are the few ways in which you can protect your portfolio. Now, which one works, which one doesn't? Let's look into some of the statistics. Hold on, this will be eye test. Okay, so S&P 500. So there's a statistics done in Europe. In one of the previous sessions, those 4-hour sessions, I've shared the whole report. Not gonna go through the report, but I took a screenshots of from the same study. S&P 500, starting this 2002 all the way till 2019. And this means you have gone through the crash of 2008, a great financial recession, GFR. And then you also get into the mini crashes of 2015, 2018. If you just held your S&P 500, that were the best, right? But who knows that where the market is going to go? If you bought a protective put, that means here the portfolio value is done way worse than just holding the S&P 500. Put spread, and again, this is like S&P is at 100 and you're putting a spread at 95.80, means buying a 95 put, selling 80 put, then another put spread, then the collar 95, 105 means 95 you buy a put, sell 105. All of them did better than just buying a put. The only place where buying a put works is if you can time the market and buy it right before the market is about to crash, right? Which is impossible to do. So this was for 1 month, right? You bought these for 1 month and you kept on buying it, this protection for 1 month. It expired, you buy it for 1 month again. Expired, you again put the hedge for 1 month. This one is for 3 months, right? Not much difference in the results. This one is for 6 months. Again, not much difference in the results. Buying a put is still the worst, right? I think this one is for 12 months. So instead of buying 1 month, you bought, let's say, went out, and instead of buying a protection till 20th Jan, you bought a protection till the 12-month rolling period, which is, let's say, 15 December 2023. That's the closest. Okay. And then the same thing we did for the others. And then you kept on, after that expired, you kept on, you added the same protection again for next 12 months. So conclusions were, it's the worst strategy, but you won't hear, especially those who are, only doing a surface level understanding, or those only who have a surface level understanding of options will probably gear towards buying a put, but it is the worst strategy of all. Only time it works when you bought just before the crisis, but which is saying, and you need to have a crystal ball, which no one has. Put spread is better than put, but is not ideal for portfolio insurance. It provides a modest protection against, protection against modest drawdowns, but not for a huge drawdowns, right? So let's say 370, you were protected, at 370, right? But what if it falls down to 300? It doesn't work for, it's better, but doesn't provide you from a risk reward perspective. It's not good enough. Third one was collar, which over this 2002, 2019, 17-year time period, collar turned out to be a better strategy from a protection perspective. Right? Now, depending on, how much, let's say, seller remorse you might have, you will have to adjust your strike prices of those collars. Right? But overall, collar provide a superior protection against the tail risk, as well as from a modest drawdowns in the markets. Right? It is suitable for investors who are more concerned with the downside risk than losing on the upside potential. Right? Because you are actually committing to sell your portfolio if it goes to 420, right? If the portfolio is at 430, you are still sold at 420. But as long as you're happy with that, you're happy that you made from 400 to 420, you made enough and have no qualms about selling it, but you are more nervous about protecting your portfolio. You don't want that downside risk, then the collars turns out to be the best. Now, what I'm trying, and I did this week, again, I did it on QQQ. So I want to share the one QQQ, right? So I did this one, which is, I went out 3 months, March, right? And I don't hold any QQQ in this account, but given the fact most of my top positions, I have a lot of a tech. I did the same thing, which is I sold, I bought a put spread, which is 260 put, and then a 230 put, means I bought 260 put, sold 230 put. 260 put is like from 290 till 260, which is like 10%, So I'm like, yeah, if market goes down 10%, I have other ways to protect my portfolio, which is I'm already selling call spreads on QQQs and SPYs, right? So I don't have to worry about, because those I do it on bi-weekly basis. But I want to take a longer term hedge, which is, if it goes beyond 10% drawdown, I want to take little protection. So that's why I put 260. Now, would have been super expensive. So I have to sponsor it, saying, do I think the market will go beyond 230? Right? Which is like said, will QQQ fall below 20% in next 3 months? It is already beaten down a lot. So I don't think QQQ will fall more than 20%. So I don't have to protect myself beyond that fall, below 230, because I don't think it's going to fall there. I could be wrong. If it falls, I'll be in a buying mode. That'll be a perfect opportunity to get back up the truck kind of. no, never back up the truck. But I'll be very happy when it falls because it'll give a lot of buying opportunity. But I don't think it's going to go beyond 230. So I don't have to buy any protection beyond that. So you end up, so I sold a put over at 230. Now, okay, to sponsor this, went ahead and sold a call spread, which is 340, 360. Right? Now, why I did 360 is being eternal optimistic. I don't want to lose the upside potential if market continues to go higher. So, and I did, 3 contracts of it. Maybe I'll figure out something similarly on SPY. But the reason I picked 10% is I think 10% drawdown I can manage, not worried about it. There are a lot of other hedge trades, which is on a bi-weekly basis or expiration basis. I continuously do it anyway. So I need, for example, we talked about it. I have a call spread on RUT. I have SPY. I have some positions on SPY, which are, if it goes down, this one is gonna, make some decent money. Oh, geez, let me just hide the positions. Oh, sorry, hide simulations. Yeah. So I have those protections. So from a long-term perspective, I did something on QQQ. Okay. So that's one example of what I did, and that's why I talk about it. On some ways to get some protection on your portfolio. Any questions? Those who have been using it, what strategies have you used? Dave says sell, bear, put spread. Ramesh says roll the call higher. Okay, if the market goes higher, yeah, you roll the call higher, but then you take a little bit of a debit. Yeah, that's all around how you manage your positions. If a market goes higher and you don't want to let your stock go, there are different ways of managing your positions. So that gets more into position management. Cool. Any questions on protection or portfolio protections? Again, this is a very interesting topic. There are a lot more that gets into it, is how much protection you want, like instrument what you choose and all that stuff. So, but from options perspective, this is how you can use some of these option strategies. There are more complex option strategies, like you could construct a butterflies, but I don't want to get into that. Those big, let me put it, those become, a lot more complex to manage. And if you're a, newbies, stick to the easier one and the optimal one, right? Buying a put, won't recommend, unless you have a crystal ball. Go ahead and buy a put, but you end up losing a lot more money if you continuously buy a put. All right, think that's so what we hit 12 marks. So I'll skip the quantum computing then, because it will need at least 30 minutes to go over what's happening on the quantum computing and investment opportunities. Yeah, but we'll be happy to take any questions, or if you have any other different thoughts. So we'll cover quantum computing next session. Special options training today. I don't know, Dave, which special. So today, why? Okay, you're referring to this particular topic. Yeah, because there was a lot of people are concerned and nervous about portfolio, And since the name of our group is Option Geek, I mean, I started this group to talk more about options. And, so yeah, get back and maybe, talk a little more details around the options. That's what. Maybe if there is more interest, maybe we can pick up and start picking up, individual option topics. But I think most of the folks, which are names I see here, you've been around for 2 years. You've gone through many of those boot camps already. So I don't talk about option strategies generally, unless there is an interest. But portfolio protection, I did want to talk about. Dave says, I'm done day trading. Day trading has never been my forte. This is something which I can't do it. And I don't think it suits my temperament. But there are people who are interested in day trading too. But I'm more interested in buying great companies than use options to reduce the cost basis, put hedges so that I can still stay without being nervous. How to roll call higher. So when we talk about rolling the call, and I'm again looking at when you sell a call, right? Not buy a call. So let's get rid of these. Let's say I sold a call at 420. Okay, let me then create I don't have any SPY in this account, so let me create SPY. Oh, I had, we just build the whole SPY hide position, then we will have it. So roll the call higher means hold on, let me just clean some of that stuff up. Now, generally what I do, and this is what I've been doing, is selling call against the stocks that I hold. And, or selling calls. So selling calls against the indices and selling call spreads against some of the volatile stocks that I hold. When I say volatile, means those stocks could go up 20% in a day. So, but I continuously, try to reduce my cost basis by selling these calls, etc. So let's say if I hold 100 SPY, and this is not hedging, this is reduction in cost basis, right? So during my earlier part of journey with options, I used to confuse this with hedging. Now I say this is not hedging, it's reduction in cost basis. Is selling your calls or call spread is a reduction in cost basis. So say I sold this call, means for next 50 days, I'm going to collect $5 right away, which reduces my cost of owning the SPY to by $5, right? But say SPY is at 420 or, it starts to go higher. Now I am getting nervous about, I'm going to lose the upside. Then you roll the call higher means you buy some whatever time, you come and buy this back, and then you sell a call at a higher price. So this is called rolling the call higher, right? But if you roll that call higher, you basically pay a debit for it, but you get more upside for you. So instead of your shares getting called away at 420, now your shares will be getting called away at 430. So you picked up a higher strike price. So it means you rolled your call higher. It means if SPY continues to go higher, you won't get cut out at 420, right? You won't be out of the market at 420. You will be able to enjoy your upside all the way till 430. So that's what means rolling the call higher. Means you close your current position, buy back your current call, and sell a call at a higher strike price. Okay, terms roll and option roll up refer to closing an existing while opening a new positions on the same option at a higher strike price. Dave, if I received email. I received email this week that they will be migrating, but Yeah. Again, it was a long email which states how it will be better. I didn't go through all, but I was looking, okay, when are we going to migrate? And are they going to, one thing which I liked in that email was that they'll still retain Think or Swim. I'm like, okay, I'm good. But yeah, less competition. We'll see what happens to the fee. Cool. All right. Anything else? Anyone looked at some new stock? By the way, so we had, from a stock perspective, we saw CRM got hammered after earnings. I don't have any positions in CRMs, but okay, let's do 1 year, 1 day. CRM was hammered after earnings, was down almost 8.5%. I don't know. Now it looks interesting to me. I never owned CRM. I don't know why, but maybe now I could dip my feet in CRM. The market didn't, I mean, the numbers were okay. What market didn't like was that the co-CEO, Brent Taylor, he decided to move out of CRM, to start his own venture. This is, I think, in the 3 years, there's a 2 co-CEOs have quit. So there's some concerns around that. P is still 270, super high. I'll have to look. I have not looked at the financials. So, but I always admired this company for whatever reason. I never held this stock, but now it looks to be, at start of the year, it's been almost cut in half this year. What do you think? Is this anyone have done more research on CRM? I mean, Mark Benioff is a great acquirer of companies, has been a CEO for 25 years. What do you think? So the CRM was then Snow was there. I think market didn't like, after earnings, Snow was up. Oh, for a change, Snow was up.
Excuse me. What Benioff? What was the difference? He seemed more like a chairman than a CEO.
No, he was a co-CEO. He and Brett Taylor, both of them were co-CEOs, and now he has become a CEO because of Brent Taylor. He decided to quit. Now the concern that market had was Mr. Taylor. He was the guy who executed the stuff. And Mark Benioff is more a little higher level, which is strategizing it, what companies acquire, but to implement that strategy, he need a lieutenant who can, execute the vision that he had. So from now, with the Taylor gone, Benioff is going to be the only CEO. So he was a co-CEO and chairman. Now he's going to be the sole CEO. Even before Taylor, there was another person, and they both of them also had co-CEO roles. There are few companies. I mean, this whole co-CEO structure is not very common. There are not a lot of companies that do it. I think maybe I'm aware of only one other company. So I don't know how they divide the duties, and is that a reason why it really doesn't work out that great? Because who's going to manage what? It's the blame. So this is a little different structure. Can you do a short analysis on China stocks, KWeb, Baba, JD, FXI? I am actually long thesis on China. My only short thesis is geopolitical risk. So that's my only short analysis on overall China stocks. Is they could get shut out. They could close China investment in China companies for US investors. Other than that, Baba, I like Baba. I've been for quite some time. Stock has been beaten up really bad. but it's only, what, plus 2-3 years. But it's a great business. From business perspective, it's great business. Of course, there were some anti-competitive concerns, and that's where the Chinese government started to tighten the noose on Baba. But I think we are past that. Right now the COVID and the geopolitical concerns are way bigger concerns. KWB is an ETF, so this is not individual companies. JD.com is a competitor to Baba. Again, very efficient in terms of quality control, and they own the warehouses. So I'm also okay on JD.com. We can own both. FXI is again large market cap ETF, so not an individual company. Again, from a stock and growth perspective, I hold a bullish. The company's perspective, I have a bullish thesis. Stock perspective, I would say, if you can't stomach the volatility, then don't be in that stock. The business can be great. Stock could be pathetic because we may not be able to invest, or they might just say, we are nationalizing the company. What do you do? Nothing. Then the shareholders will just get wiped out. Right? Business might still be doing great. Shareholders could still get wiped out. So that's a big risk of government control, the control that the Chinese government can exhibit on any Chinese company. That's overall, if you're investing in China, you have to be comfortable with the fact that what if Chinese government take over the company? What if Chinese government put more curbs on the company? What we have seen on Baba, right? They told Didi that you can't take on more accounts. These things are unheard of in US. You can't tell a private company saying, okay, don't sign up for more users. But that's what China did with Didi, saying no more, you can't take on many more users. Fix this, fix that. So that's a big risk on if you're investing in China. For some, China is uninvestable, which is perfectly okay. There are a lot of other great companies. You don't have to go to China. But if you want to, you make sure you're comfortable with that concept of government can take over these companies anytime. Ramesh, they say solar stock jumped higher this week and phase was up 20. Now, this is one area where I have zero exposure. But I think oil and gas exposure has done good this year. Dave says, I'm looking into oil and energy space. I think Russia boycott might backfire, sending energy higher. So there was some, because this whole energy stuff is so politically charged, which we can't put a finger on what's going to happen. So there is a cap. I think Sundays, tomorrow is when the OPEC Plus is going to get together, probably on Zoom, to decide the next course of action in terms of a cut in oil production. So if they decide to cut oil production, then the energy, basically the oil stocks will go higher, ETFs will go higher. But there was another news around, Biden, President Biden trying to, it was around giving immunity to Saudi Mohammed bin Salman around for basically providing immunity so that he cannot be prosecuted for this Khashoggi's murder and all that stuff. So I don't know, a lot of political back dealings happening. Maybe that is to appease MBS so that MBS can veto the decision of oil production cut. Who knows what's going around over there. Third thing was European EU, and I think a lot of West allies of EU are deciding to put a cap on the price of the oil that they are willing to pay for Russian oil. I think the price cap being discussed is $60, but currently I think Russia is anyway selling lower than that. So I don't know how that is even effective. And countries like China and India, they are anyway will continue to buy from Russia. They are not playing along with what US and EU wants to do. So I think that stuff is immaterial. So a lot of this whole oil is a lot of stuff. So my plays, I mean, I have shared earlier from an oil perspective, I've been holding AMLP for now. I started those positions in 2020. Now those are like up 100% plus. Let me just put where my intent was a good dividend paying a fund. So Illyrian AMLP. Other one I have is XLE, which I hold stock. And then I have a strangle. Do I have a strangle or do I have a put spread and a strangle? Like probably I'll have a put spread and a call. Yeah, I have a put spread and a call. Yeah. And if it all goes further down, I'll pick some more XLE. If it stays here, we'll reduce the cost basis. If it is go beyond 105, we'll be happy to sell. I bought this at 75, but when did I buy this? Started picking this in July, and so far I've reduced the cost basis by $10 already. My cost basis, I think, over the premiums that I've taken in option trade is already $10 premium, which is decent enough. So I'll continue to do this. And then I own Berkshire Hathaway, which is, again, I get exposure to OXY. But this energy is super politically charged stuff. Cool. All righty. Yeah, BRKB. All right, looks like that's it for today then. Where's Apple going? I don't think Apple can go anywhere. Short term, there are headwinds around Apple because of China lockdown. Not lockdown, it was a walkout in the Foxconn plant, right? The workers just staged a walkout because they didn't get the fair share of wages or whatever was being promised. There were concerns around the COVID and all that, but I think Apple is anyway looking to de-risk from China and setting up a manufacturing plant in India, which bodes well for India ETF. But they've got such a strong balance sheet. They are still doing these AR, VR. I think I'm not concerned about Apple. If nothing else, they'll continue to buy back the stock and increase the value of the stock. Is Apple a growth company? It used to be, probably not. But Apple is, all the companies go through the whole cycle of, the S-curve of their company's growth. Right? So Apple is now into the maturity cycle wherein they are buying back the stocks, they are paying dividends, they continue to generate good cash flows. So Apple is still my top holdings in my portfolio. I'm not worried about Apple. Any FTX stock? We want to open up that Pandora's box. There has been tons of FTX stock happening. Like I said earlier, he came on, which was the Deal Book Symposium, where Andrew Ross Sorkin interviewed him. I don't know why Andrew Ross gave him was throwing just a soft ball. It was always kind of, giving him an answers. Was very soft on him. For whatever reason. Why is media, giving such a favor to Sam SBF? I don't understand. Then I think he also interviewed on some channel where that George Stephanopoulos is. I forgot what that channel is. He also gave an interview there. Funny thing is, he was on a Twitter space. So I did join Twitter space. And he was talking a lot more about that, We were almost there for 2 hours on the Twitter space. So I don't know who is advising him, but I've never seen someone who has been charged with such a big fraud and going around and giving these media interviews. So there's been, I think, so the lawyer of those who had represented Bernie Madoff, the biggest fraudster that we know of as of now, that lawyer had a comment saying, I have only one advice for Sam Bankman-Fried, and that advice is shut up. Don't give. But and some people say, there are some thoughts that maybe this is the strategy, that Sam's lawyer might want to play a game wherein this guy doesn't know what he's doing. So he never knew what he was doing when this whole FTX fiasco was happening. Right? It looks like he's not in, he doesn't have that maturity. He's going and talking to the whole media. So who knows why it's happening, but this is something which is unforeseen. That's why media is latching up on, but I'm tired of, FTX narrative. The worst thing is the list of podcasts that I shared yesterday, last week meeting. All the episodes have something on FTX. I'm like, I had enough of it. Spare me. I don't want to hear more about FTX. But this is where it is. Yeah, media is soft because they want to score interviews. I get it. But this guy is going to get into jail. Right. So I understand if you're talking, I'm not going to ask tough questions to Andy Jassy. I don't want to put Mark Benioff on the spot because, hey, I need to interview him for some other, meeting, because we want to build that relationship. So to answer the question, Jay, I understand why sometimes media won't really charge on CEOs, because they want to have the relationship where the CEO will come and say, yeah, I'll talk to you. If you're going to beat up the CEOs every time in an interview, no CEO will be willing to talk to you. But this guy is going to go in jail. So I don't know why they're being soft on that. Financial engineering crimes are not crimes as per this. All right. Thanks, Dave, for thinking about me. Yes, I am hungry. So let's stop it right here. Otherwise, we can go on and on. There are so many things happening. We have to take a stop somewhere. So let's do it right now. So thank you, everyone, for joining in today. I'm thankful, as always, for you guys to come and talk. Keep me honest. Keep me closer to market. I learn because I have to come and teach. That's what I said. Right? Teaching is the best form of learning. So, which is now what I've been experiencing for past few years. So thank you all. We'll talk again next week. If you have any specific topic that you want me to pick up, maybe just ping me on a meetup, or if you're in a Slack channel, just ping me there on Monday, Tuesdays. It's generally on Thursdays, Fridays when I start to think through, okay, what I want to do for this week. Cool. All right. Thank you, everyone. You guys have a wonderful day.